What's going on YouTube? My name is Zachary Kramer with Progressive Payment Solutions and welcome to the PPS vlog. Today we're going to talk about MCA loans. Let's begin. MCA stands for Merchant Cash Advance. So obviously it has to do with your merchant account. The difference between a regular loan and an MCA loan is that a regular loan typically is for a longer period of time, usually more than a year, where an MCA loan is typically a short period of time. These loans are usually higher risk. Typically the merchant can't go to the bank or doesn't have time to wait for the bank to process the loan for whatever reason. And usually these loans are a year or two max. They're usually not much longer than that. And how it works is at the end of a certain amount of time, which you discuss with the lender, you're going to be paying back the loan with your credit card receipts through your merchant account. So let's say, for example, you process $10,000 a month in credit cards for argument's sakes. So $5,000 of that $10,000 will actually go to pay back the loan. Now these are very crude, rudimentary numbers. It's just an example. But let's dive in a little bit deeper. Some of the advantages of an MCA loan is the speed at which you get the loan. It typically takes 24 to 48 hours from paperwork to when the loan is funded, so it's very, very quick. The simplicity, again, it's pretty easy to get the loan. And then also the flexibility of the loan. Let's say 1 month your credit card sales are down. You're not paying as much into the loan as you would if credit card sales were up. So essentially, it's a much easier way to pay something back, especially if you're in a business that fluctuates either based on season, time of the week. You know, some restaurants are busier on Saturdays than they are during the week. Now, that would more apply if your MCA loan's daily. Usually they're not daily, but anyway, it's just an example. Let's talk about some of the disadvantages of an MCA loan, why a lot of people avoid them. The first is the high cost to borrow the money. The average APR can range between 20% all the way up to 200%. It's pretty crazy what the rates can be. And again, that depends on you and your business. How is your credit and things like that. There's a reason you're not going to the bank to get that loan. Another reason people avoid MCAs is because no federal oversight. Technically, an MCA loan is considered a transaction. So it doesn't have the same rules and regulations that a typical loan would from the federal government. So you definitely want to read more about that and see if it's right for you. The last reason would be debt concerns. Because MCA loans have such a high cost to borrow, you really need to sit down with your accountant and do some math to make sure that if you're going to borrow the money, not only can you pay it back on time, but is it going to be worth it? Is it going to help your business? Now that you know a little bit more about MCA loans, I hope you take this knowledge and really sit down with your accountant and figure out if it's the right loan for you and your business. If you like this video, please like, comment, and subscribe. It really means a lot to us and helps our channel grow. And until next time, see you later.